What if 99% of the financial news you consume is specifically designed to make you poorer? We live in an age of information overload. We're told that to be a smart investor, to be responsible with our money, we have to stay informed. We have to watch the market open, read the expert analyses, and track every single fluctuation of our portfolio. But this constant stream of data, this fire hose of headlines and hot takes, doesn't feel empowering. It feels like a burden. It creates anxiety, confusion, and a paralyzing fear of missing out on the next big thing, or worse, failing to avoid the next big crash. The central conflict of modern investing isn't a lack of information. It's an abundance of noise. And buried within that noise are the only two types of information that actually matter. The rest is a performance, a distraction engineered to trigger our most primal instincts of fear and greed. In this video, we are going to build a filter. We're going to deconstruct the noise machine and isolate the signals that can actually build wealth. We'll use a concept from information theory called the signal-to-noise ratio. The signal is the meaningful information you're looking for, and the noise is the random, unimportant data that gets in the way. By the end, you won't just understand the difference. You'll know how to ignore the deafening roar of the market and listen for the whispers that truly count. Most of us approach the world of finance with a simple intuitive belief: more information is better. We see the professionals on TV, surrounded by a dozen screens flashing with charts and numbers, and we assume that's what success looks like. The common wisdom is that to win the game, you must know everything all the time. You read that a certain stock is poised for a breakout, that an analyst has upgraded their rating, or that a CEO sold a fraction of their shares. You check your portfolio, see it's down 2% for the day, and immediately start searching for a reason why. This is the accepted myth of the informed investor, a vigilant, always-on consumer of financial media. There are countless stories and data points that support this. We hear about the hedge fund that made $1 billion by reacting to a news event seconds before anyone else. We're told that information is power. But if this is true, why do study after study reveal a strange and unsettling truth? The most active traders, the ones who consume the most news and make the most moves, consistently underperform the simplest strategy of just buying and holding the market. There's even a famous, though perhaps apocryphal, study from Fidelity that found the best performing investment accounts belonged to people who were either dead or had forgotten they even had them. This presents a crack in the foundation of our belief system. What if the constant flow of information isn't a tool but a trap? What if being less informed, but about the right things, is the actual secret? To reframe this, we need to introduce an analytical framework. The profound difference between structural signals and sentimental noise. Structural signals are fundamental, long-term shifts in the rules of the economic game. Think of them as tectonic plates moving beneath the surface. They are slow, powerful, and their effects are felt for years, even decades. Sentimental noise, on the other hand, is the day-to-day chatter. It's the emotion of the market, the fear, the greed, the speculation. It's the weather, not the climate. Let's re-examine a common piece of news through this lens. A headline screams, "Company X stock plummets 8% after CEO's controversial tweet." The noise here is overwhelming. The tweet, the outrage, the 8% drop. It triggers an immediate emotional response. You feel pressure to act, to sell, to do something. Now consider a different piece of information for that same company buried on page 27 of their annual report. A quiet announcement that they have secured a patent for a new technology that will cut their production costs in half over the next 5 years. This is a structural signal. It has almost no immediate emotional impact. It won't be the lead story on the evening news. But its effect on the company's long-term value is 1,000 times more significant than any tweet. Here we find our first real insight. The vast majority of financial news isn't designed to inform your long-term strategy. It's designed to provoke a short-term reaction. Its business model depends on your engagement, your clicks, and your anxiety. If everything we've established is true, that we should focus on the long-term signals and ignore the short-term noise, then we have to confront the ultimate counterexample, the 2008 financial crisis. In the months leading up to the collapse, the daily news was a firestorm of panic. It was terrifying, and it was undeniably noise. Headlines about banks failing, markets crashing, and mass layoffs were pure, unfiltered sentiment. Yet ignoring that noise would have been catastrophic. Reacting to it, selling your assets and moving to safety was, for many, the absolute right decision. This single event seems to shatter our entire thesis. It proves that sometimes the noise is the signal. It suggests that you can't afford to tune out the daily panic, because you might miss the one time the panic is justified. This forces us to ask a much deeper, more critical question. If the daily headlines are usually a trap, but are sometimes a vital warning, how do you possibly tell the difference? To answer that, we have to stop looking at the news itself and start analyzing the two and only two types of information that can ever truly justify a financial decision. The reason we get this so wrong isn't because we're unintelligent, it's because we're human. Our brains are hardwired by millions of years of evolution to react to immediate threats. We are designed to notice the rustle in the grass, not the slow erosion of the coastline. This psychological wiring creates cognitive biases like loss aversion, the feeling that the pain of a loss is twice as powerful as the pleasure of an equal gain, and FOMO, the fear of missing out. Financial media is a master at exploiting these biases. Every headline about a crashing market triggers your loss aversion. Every story about a crypto millionaire triggers your FOMO. This creates a powerful emotional cocktail that overrides rational long-term thinking. This struggle is not new. It's the same battle Odysseus faced in the ancient Greek epic. He knew he couldn't resist the beautiful, deadly song of the sirens, so he didn't rely on willpower. He created a system. He had his sailors plug their ears with wax and ordered them to lash him to the mast of the ship, forbidding them from freeing him no matter how much he begged. The daily financial news is our siren song. It's alluring, it sounds critically important, but its only purpose is to lure you towards the rocks. To navigate it, you need a system, not more willpower. But I know what you're thinking. What about day traders? What about the people who make a living trading off this minute-to-minute volatility? They seem to prove that a deep engagement with the noise is not only viable, but profitable. That moment of a stock dropping 5% because of a bad headline is precisely where they find their opportunity. This is the strongest challenge to our argument, and it seems to refute everything we've said. But here is the critical distinction. They are not playing the same game. A long-term investor is trying to own a piece of a business that will grow in value over decades. A day trader is a professional who is working a job. That job is to extract tiny profits from the market's emotional, short-term overreactions. They are not investing in the company's future. They are arbitraging human sentiment. For 99% of people trying to build wealth for retirement or financial freedom, attempting to play this game is a guaranteed path to failure. And so we arrive at our second major insight. Adopting the strategy of a day trader for your long-term goals is like a passenger on a Boeing 747 trying to land the plane by watching a YouTube tutorial on how to fold a paper airplane. Even if the principles look vaguely similar, the context, the stakes, and the required skill set are so fundamentally different that the comparison is not just useless, it's destructive. So let's assemble the full picture. We are surrounded by a deafening noise machine powered by our own psychological triggers. We have the daily market fluctuations, the sensationalist headlines, the so-called expert predictions, and the temptation to believe we can outsmart the system by playing a game we're not equipped to win. All these pieces come together, creating a constant pressure to do something. The true breaking point for an investor, the moment where wealth is most often destroyed, is when they confuse these two separate worlds. It's the moment they sell a wonderful, long-term business that they believe in, all because of a scary headline that represents nothing more than temporary market sentiment. It is the moment the noise finally defeats the signal. Now that we understand the machine, we can finally define the only two signals that matter: long-term, structural changes to the economy, and company-specific, fundamental changes to the business. Now we understand what to filter for. So, what does that mean for our final question? How do we use this filter, not just to survive the noise, but to harness it to our advantage? The answer will redefine your entire relationship with money.